The balance sheet may be the least understood and utilized of the three financial statements, but I'm about to show you how to use a company's assets, its liabilities, and equity to not only find the underappreciated investments, but avoid some of the biggest traps in stocks. We're talking balance sheet analysis today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, we looked at the other two financial statements in the series, and I should have started with the balance sheet because it doesn't get nearly enough attention. It's not those bottom line earnings you get with the income statement or the ability to see that actual cash generating power. But this is the best financial statement for finding how management is leveraging the company's assets to profit, and absolutely critical in avoiding some of the biggest traps in stocks. So in this video, I'll explain the balance sheet, what it shows you, and how to use it to find the best stocks to buy. We'll start with the balance sheet basics, then I'll show you how to analyze this financial statement and the simple ratios that will make you a better investor. It's all part of a special investing education series I'm starting, showing you what it really means to analyze stocks and invest your money. I'll be using content straight from the curriculum for the Chartered Financial Analyst designation, the gold standard for stock analysts working on Wall Street. The designation involves 3 years of exams and thousands of pages of curriculum, but I'm going to be laying it all out for you in these videos. I'm going to be putting this one and all those videos into a playlist called How to Invest in Stocks right here on the channel. Make sure you tap that subscribe button so you don't miss any of these, because I've got some great in-depth videos coming, from options trading strategies to technical analysis and how to beat those investor behaviors that lose your money. We've already covered the income statement and the statement of cash flows. And nation, understanding these three financial statements is critical to investing, not just when the market is booming, but because everyone makes money in an up market. But being able to analyze these financial statements is going to make sure your portfolio produces those same kinds of returns even when the rest of the market is losing money. The balance sheet shows the detail into a company's resources, its assets or what it owns, and its sources of funding, so the liabilities or what it owes, and the equity ownership of investors. And there's a basic formula that every investor should know, that a company's assets minus its liabilities, what's left over is the equity, your ownership of the company as an investor. Now I'm going to take you step by step through the balance sheet, through each section to explain what goes into each. And it's important here to understand that the balance sheet is like a snapshot of these accounts at a specific time. So what the company owns, what it owes, and the investor ownership on March 31st or whatever the date is. Now that's important because it's different from the other two financial statements that we looked at. Both the income and the cash flows show the activity over the last 3 months. The income statement is all those sales and the earnings made over that last quarter, that period, and the cash flow is the actual cash generated or used during the period. Now this is going to be more important when we get to those financial ratios for analysis, but basically it just means you always want to be using the most recent quarter's balance sheet. If you're on the income statement or the cash flows, you can use the annual or the quarterly because maybe you want a different period for your analysis, but you always need to use the most recent balance sheet. That's the most recent quarter's numbers to get those up-to-date numbers. But let's get into those numbers here, and I promise you don't need to be an accountant to understand these. I'm going to walk you through the basics of balance sheet analysis, and we'll be using the Apple balance sheet here as an example to make it easy to understand. Every balance sheet starts with the assets. That's what the company owns, and this is broken down into two sections, current and non-current. Current assets are anything that can be turned into cash within a year. So here you're going to see these cash reserves. These marketable securities are all liquid stocks, bonds, or money market that can be sold quickly. And I'm going to detail these other lines in a moment. And you're going to see that Apple has just over $93 billion in cash and those short-term investments, and over $140 billion in total current assets. Now, current assets are important because it's liquidity. It's immediate cash that the company can tap to pay its debt or buy other companies. It's also a great place for analysis in two of these lines, the accounts receivable and inventories. This lower section then is the things that the company owns on that longer term assets. This first line is investments in stocks and bonds that the company plans on holding for longer than a year and is over $100 billion just in that account. Now, property, plant, and equipment, also called PP&E, that's all the factories, equipment, those real assets that it owns. Then this other current assets, and I wish Apple broke this down in the statement and not in the notes, but this is going to be intangible assets. Now, these are all the things that have value but aren't physical objects. Here you've got the value of a company's patents, as well as anytime a company acquires another company and pays more than the market value, The difference there, the extra that they paid over the market value, that goes in here and it's called goodwill. And the money Apple has in cash and those marketable securities, that's been a big discussion point over the years, right? If you just add up the cash and the investments from those two sections, Apple is sitting on almost $200 billion. Now that's not all bad. A company needs cash reserves, but what's at issue here is that it's earning next to nothing on that cash, and it's not in the business of investing in stocks. So management needs to do something with that money, invest it into acquisitions, R&D, or just return it to shareholders instead of just sitting on it. Now let's look at a few of these other lines because they're absolutely critical in your analysis. Now the accounts receivable number here is net, which means it's all those sales that the company made on credit. A customer bought the product but hasn't paid for it yet, and then Apple estimates how much of this is never going to be fully repaid. So what you end up seeing here is just what Apple thinks it's going to collect on those credit sales. Again, like we saw with those other two financial statements, you need to do a little detective work here in the balance sheet to find how much Apple is estimating that it won't be paid on those receivables. It's a very important measure of its credit and how well it's doing. And what you can do here is just follow the trend in that from quarter to quarter. Is the company selling more on credit as a percentage of its total revenue? Is that amount it estimates to go into uncollected, is that rising as a percentage of its credit sales? And this is really important because what you're going to see when a company gets into trouble, it's going to start relaxing those lending standards and selling more of its product on credit. That might work for a quarter or two because they get to show a bump in that revenue, but it's going to catch up because if those are lower quality customers with bad credit, a lot of these receivables may never be collected. Now, inventories is another important line here, and it's all that unsold product piling up at the company. So if this is rising over several quarters, you have to wonder if the company is making some outdated products that nobody wants anymore. The last item here, and we'll look at this next section on the balance sheet, but this other non-current assets. Again, this is the non-physical, intangible things that the company says it has value, like patents and the value of an acquired company. The problem here for analysis is while that some of these do have value, the patents, the intellectual property, there is value in that for a company, but it is so subjective, especially the goodwill, because that's just whatever the company overpaid when it acquired another company. So often you hear about a company having to take a write-down of their assets, and this is where that happens. Management grossly overestimated the value of a patent or of an acquired company, and it has to lower the amount booked in this line by billions of dollars. In fact, a lot of analysts, and this is what I did when I worked as an analyst, I just removed this line from the assets. For Apple here, I would reduce the total assets by that $41 billion and then take the same amount off stockholders' equity at the bottom. What that's going to do, it's going to remove that arbitrary number from the balance sheet, and you can do your analysis only on the real physical assets owned. This next section, the company's liabilities, is broken down in the same way. Current liabilities are what the company owes within the next year. Accounts payable is money owed to suppliers. This other current liabilities line is probably owed wages to employees, taxes payable, and then some warranty costs. Then the non-current liabilities are what the company owes over that long-term period, the bonds it's issued and the long-term leases that it's signed for its factories and its equipment. And here you won't be spending quite as much time with those current liabilities, other than just to watch the trend to make sure that they're not growing too fast. But that long-term liabilities section is going to be hugely important. You're going to want to watch that debt to make sure the company isn't borrowing to cover up other cash flow problems or getting in over its head with leverage. For example, the company may be a star dividend payer and buying back its own shares, but is it doing it by issuing more debt or from genuinely rising operational cash flow? Is it putting the future at risk by acquiring every company in sight and just financing the purchase? Now, this last section here, before we get to that analysis, the shareholders' equity. And again, this is just what's left over of the assets after subtracting everything the company owes. How much of those assets do shareholders actually own? Now the fun part. I'm going to show you how to use this to analyze any stock. Really dig in and make sure you're investing only in the best. We'll cover balance sheet analysis as well as the most important ratios every investor needs to know. Some of this analysis I built into our stock comparison spreadsheet, an Excel spreadsheet for comparing stocks and managing your portfolio. I'll leave a link in the video description below and a special discount code, so check that out. Now, just like we did with the other financial statements, we can start our analysis with a common size statement where we take each of these rows as a percentage of another. So here I've downloaded the balance sheet, and you can get this right from any company's investor relations page or most investing platforms. And most common is to take each of these lines as a percentage of total assets. So you'll take each of these and divide that line by the total assets reported in that year. Now that's going to show you what percentage of the assets is represented by the accounts receivable or inventories or its debt. And I know all these numbers and the spreadsheet can be confusing at first glance, but it's actually really simple. You're basically just copying one formula across each line to show you those percentages. And this type of analysis is hugely important. It's going to help you spot the trends and the warning signs in a company. For example, if this accounts receivable is growing as a percentage of assets, maybe you want to make sure that the company isn't relaxing its lending standards just to book more sales. Or if inventories are growing, does the company have a problem with its unwanted product? Now, looking at Apple's balance sheet, we can see that cash and those short-term investments have grown from just 20% of total assets in 2018 to 28% last quarter, so a sizable increase, but it's also down from 31% earlier in the year. Now, Apple obviously has no problem with growth, but if this were another company, I would wonder why management can't put that cash to work. Inventories seem to be fairly consistent here with no big buildups, and accounts receivable has trended up from 8%, but it's back down from 14%. It's a slow shift to selling more on that credit to those telecom carriers, but it doesn't look like it's getting out of hand just yet. A long-term debt at the company is stable under 30%. Yeah, obviously with that much cash set aside, it doesn't need much debt financing. Now, the other way that you'll use these common size statements is to compare against other companies. For example, does one company have more current assets or long-term assets on the balance sheet? Now that can be an indication of which is better at using those assets for that long-term growth rather than just having it sit there in cash. You can compare the ratio of current assets versus those current liabilities for each company. So how likely is it that each is going to be able to pay those short-term debts? Another good one here is comparing companies by the percentage of total assets in those intangible assets and which have more in that property, plant, and equipment type of assets. And that can be a great comparison to find companies focused on that internal growth versus those that have focused on buying growth through acquisitions and have more of that goodwill and intangible assets. Next, the financial ratios are really where the balance sheet becomes a critical part of your analysis. And you're looking at two types of ratios here. Liquidity ratios show you the company's ability to meet its financial obligations. Then solvency ratios here, those measure the ability to meet the long-term obligations. And then just like that common size analysis, you can use these to watch for trends at a company to see if it's trending to less liquidity over time, or you can compare them across companies, which company is in a better solvency position. Here are your 3 liquidity ratios, and these are all taking something from the current assets, those short-term assets, and then dividing by current liabilities. For example, you can take just the cash and marketable securities, those 2 items most easily converted into cash, and see how well that covers the payments the company needs to make within the next year, its current liabilities. Now, these liquidity ratios are going to be hugely important when you're analyzing companies in severe financial trouble, or if you think that we're heading into a recession. You want to make sure that the companies you own can meet those short-term needs with what they've got set aside. The solvency ratios are then going to be that longer-term idea. What percentage of the company's financial structure is made up of debt? So you've got just a couple of different ways of measuring this, and I'll usually use that long-term debt to equity ratio most often to watch that trend in the long-term borrowing. It's a lot to take in, but remember, this is the kind of analysis that a lot of investors avoid and that will really set you apart as a better investor. Click on the video to the right for the first financial statement video in our series, Understanding the Income Statement, probably the most popular financial statement and some great tools for analyzing your stocks. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.